Picture this. You're cruising through the year, your income flowing in, maybe from a new freelance gig or, investments hitting big. Everything feels smooth until, bam, tax season arrives, and you're hit with a surprise penalty from the IRS.
Ah.
It's like finding a hidden fee you never knew existed, a direct hit to your hard-earned money. What if we told you there's a straightforward path to avoid that entirely, to keep more of what you earn, and to sail through tax time with genuine confidence?
Yeah, and this isn't about trying to dodge your obligations or anything like that.
No, not at all. It's about smart, proactive financial planning to prevent those unnecessary costs and keep your money where it belongs with you.
Precisely. Today, we're taking a deep dive into Form 1040-ES. A lot of people see it as kind of an unsung hero for anyone navigating income streams not subject to traditional payroll withholding.
Right.
This isn't just another government form. It's truly your roadmap. It helps you understand and effectively manage your estimated taxes for 2025, making sure you're not only well prepared, but actively preventing those costly, confidence-shaking surprises.
So the mission today is really about demystifying these estimated taxes.
Exactly. Demystify them, spotlight the proactive strategies that can genuinely optimize your financial picture, save you some money on penalties, and break down the mechanics of making accurate, timely payments. It's all about securing a more tax-efficient future.
Okay, let's unpack this. Because for so many people, especially like those who've jumped into the gig economy, started their own thing, or maybe diversified their income with investments, estimated taxes can feel like a whole different ballgame compared to just having taxes taken out of a regular paycheck.
Oh, definitely.
So at its core, what is Form 1040-ES really about? And why is it so incredibly crucial for certain taxpayers?
Well, what's truly fascinating here is that estimated tax is essentially the IRS's elegant solution, maybe, to ensure that tax is paid progressively throughout the year on income that isn't subject to the traditional withholding we're all familiar with from a W-2 job. Think of it less as a complex calculation and more as your ongoing contribution to your annual tax liability, but spread out, distributed over time rather than one massive, overwhelming lump sum due on April 15th.
Right, avoiding that big shock.
Exactly. For salaried employees, taxes are typically removed automatically from every paycheck, almost invisibly. But for the self-employed entrepreneur, the savvy investor, or someone receiving other significant income sources, that automatic mechanism just isn't there.
Makes sense.
So Form 1040-ES provides the framework for you to fill that gap, letting you proactively manage your tax responsibilities.
So it's about creating a level playing field, making sure everyone contributes to the tax system as they earn, rather than facing a huge bill at the end of the year. That makes perfect sense. What are some of those common income types that should immediately signal to someone, hey, maybe I need to look into estimated payments?
Yeah, you've hit on a key point there. The most prevalent income type that brings people into the estimated tax world, especially now with the surge in independent contractors and freelancers, is definitely earnings from self-employment.
The gig economy, folks.
Absolutely. This covers all your gig economy endeavors, whether you're driving for a rideshare service, designing websites, offering consulting, running a small online shop, you name it. But the reach of estimated taxes, it goes far beyond just self-employment.
Oh, really? Like what else?
Well, we're also talking about interest you earn on savings accounts or bonds, dividends from your stock investments, rental income from properties you own, even alimony sometimes.
Yeah.
And furthermore, if you receive unemployment compensation, or if you're collecting Social Security benefits and you choose not to have tax withheld voluntarily from those payments, then estimated taxes step in to cover the tax liability on those income streams too.
Wow. So it's a broader net than many people might initially realize.
It really is.
That's a truly comprehensive list. It underscores how diverse income scenarios can pull you into the estimated tax world, even if you don't think of yourself as traditionally self-employed. So beyond the income type, who exactly falls under these estimated tax rules? Is it primarily just U.S. citizens?
It's broader than just U.S. citizens, yeah. The estimated tax rules primarily apply to U.S. citizens and resident aliens. But it's equally crucial for residents of U.S. territories, places like Puerto Rico, the U.S. Virgin Islands, Guam, the Commonwealth of the Northern Mariana Islands, and American Samoa.
Okay.
And importantly, even non-resident aliens are subject to these rules, although they use a specific form, Form 1040-ES and R, for their payments. The underlying principle is basically, if you're earning taxable income within the U.S. system that isn't being withheld at the source,
You probably need to be paying attention.
you likely need to be proactive about these payments, exactly.
Got it. So if you're earning income in the US and it's not automatically being withheld, you almost certainly need to be aware. But how do you know for sure if you actually have to make these payments? There's a general rule, right? A two-part test that serves as your primary guide.
That's right. This two-part test is your definitive checklist, and both conditions must apply for you to be required to pay estimated tax for 2025.
Both. Okay. What's the first one?
The first condition is pretty straightforward. You expect to owe at least $1,000 in tax for 2025 after subtracting any income tax withholding you might have from other sources, like a side job and any refundable credits you anticipate getting.
Okay, so $1,000 after those subtractions.
Right. And this expect to owe part, well, it requires you to do a bit of crystal ball gazing into your financial year. That's why thoughtful tax planning is absolutely crucial here. It kind of forces you to project your income and deductions.
So it's about anticipating your tax liability, not just reacting to a surprise bill later. Makes sense. And the second condition, this one often seems a bit more nuanced, and I heard it provides some valuable flexibility, maybe a way to avoid penalties.
It definitely does. And this is where a critical safe harbor comes into play, offering you a really powerful way to avoid those underpayment penalties. The second condition states that you expect your withholding and refundable credits for 2025 to be less than the smaller of two specific amounts.
Smaller of two. Okay, that sounds helpful.
Yeah, the smaller of rule is absolutely key because it means you only need to meet the lower threshold. It gives you a valuable strategic advantage, a safety net.
Let's break down those two options within that second condition. What's option A?
Okay, option A is 90% of the total tax that will actually be shown on your 2025 tax return.
So 90% of what you'll actually owe for this year.
Exactly. This means you're essentially aiming to pay at least 90% of your actual tax liability for the current year through a combination of withholding and your estimated payments. It does require a relatively accurate forecast of your income and deductions for 2025, though.
Which can be tricky. Okay, and option B. This one often sounds like a simpler path for many people.
It often is. Option B is 100% of the tax shown on your 2024 tax return.
Ah, the look-back rule.
Right. This provides a clear, known benchmark as long as your 2024 return covered a full 12 months. So by making sure your combined withholding and estimated payments for 2025 add up to at least 100% of your prior year's tax, you can generally sidestep penalties.
Even if your income jumps up a lot this year?
Even if your income takes a significant leap in the current year, yes. This is a fantastic tax strategy for stability and peace of mind, especially for those whose income might be unpredictable. That smaller of rule is your secret weapon here. It ensures you always have the most forgiving benchmark to aim for.
That really simplifies things for a lot of people, I bet. If your last year was maybe a lower income year, you can potentially use that as your safe harbor, regardless of how well you're doing this year. It gives you breathing room.
Exactly. Lots of breathing room.
But there are always exceptions, aren't there? Is there a scenario where you don't have to pay estimated tax, even if you might technically owe a good amount for the current year, like a total pass?
Yes, there's indeed a crucial exception that can provide a valuable break. You don't have to pay estimated tax for 2025 if you were a U.S. citizen or resident alien for all of 2024, and you had absolutely no tax liability for that full 12-month 2024 tax year.
No tax liability at all. What does that mean exactly?
It means your total tax was zero, or you simply weren't required to file an income tax return for that year. This ties directly into prior year scenarios where maybe you had significant deductions or a very low income that resulted in a zero tax bill.
So that zero liability from last year carries forward?
Effectively, yes. It gives you a pass on estimated payments for the current year. It's a definite advantage for those who qualify, kind of a tax-saving holdover.
That's a great piece of knowledge to have. So a really low income year or big deductions last year could save you the hassle this year. Are there any other special rules that impact these calculations, maybe for specific jobs or income levels? I think I heard something about farming and fishing income being different.
Absolutely. There are indeed special rules that can significantly alter your estimated tax obligations. For folks in the farming and fishing industries, the rules offer remarkable flexibility.
How so?
Well, if at least two-thirds, that's 66 and 23% of your gross income for either 2024 or 2025 comes from farming or fishing, that 90% rule in Condition 2A we talked about, it reduces considerably down to just 66, 23%.
Wow, so they only need to cover 2/3 of their current year tax liability.
Right.
Yeah.
Which is a real boon for financial planning in those industries, which, often experience big seasonal income swings. And here's where it gets really interesting and provides some substantial cash flow advantages.
Okay.
Farmers and fishers have two alternative ways to manage their estimated tax and potentially bypass penalties altogether. They can choose to pay all their estimated tax by January 15th, 2026. Just one lump sum then,
Instead of quarterly.
instead of quarterly. Or, and this is often a big help, they can opt to file their 2025 tax return early by March 2, 2026, and pay the total tax due at that time.
Wait, so if they file and pay by early March, they don't have to make any estimated payments during 2025?
Correct. They completely avoid the need for any estimated payments for 2025. This offers immense flexibility and deferral, allowing them to better align their tax payments with their often seasonal income cycles. It's a huge planning advantage.
Wow, that is a massive strategic advantage. It genuinely lets them manage their cash flow in a way that makes sense for their business. That's great to see that kind of targeted flexibility. What about household employers? People paying nannies or housekeepers, how do their taxes factor in?
Right. For household employers, when you're estimating your 2025 tax, you'll need to include your household employment taxes. This generally applies if you expect to have federal income tax withheld from other sources, like wages or pensions, or if you'd be required to make estimated tax payments anyway to avoid a penalty, even without considering those household employment taxes.
So basically, if you're already in the estimated tax system or have other withholding, you've got to add those household taxes into the mix.
Pretty much, yeah. The idea is to make sure all your income and the related tax obligations are covered when you're projecting your year-end liability.
Okay. And what about folks earning a higher income? Do they face different rules? I imagine the IRS wants to make sure those folks are paying a substantial portion throughout the year, right?
You're spot on. For higher income taxpayers, the rules do tighten slightly, aiming to capture more tax throughout the year. If your adjusted gross income, your AGI, for 2024 was over $150,000,
Okay.
or $75,000 if your filing status for 2025 is married filing separately, then that 100% rule in Condition 2B under the general rule changes.
How does it change?
Instead of needing to cover 100% of your prior year's tax, it becomes 110%.
110%. So they have to pay a bit more based on the prior year compared to others.
Exactly. The IRS's reasoning here is precisely what you guessed. To ensure that higher earners are contributing a more substantial portion of their expected tax liability throughout the year, minimizing those big lump sum payments at tax time.
Makes sense from their perspective.
It does. But it's important to note that the generous farming fishing rule we just discussed, that overrides this 110% rule for eligible taxpayers.
Oh, good clarification. So farmers and fishers still get their special deal even if they have high income?
Correct. It shows how targeted some tax provisions can be.
That's a crucial distinction for high earners to remember. So knowing these specific thresholds and percentages is absolutely key to avoiding those penalties. That's a big tax-saving strategy right there. This leads us perfectly into our next section. Beyond just knowing the rules, how can people proactively strategize to reduce their estimated tax burden and maybe avoid penalties altogether?
Right. This is where the real opportunities for financial optimization for saving money emerge. If you happen to also receive salaries and wages, maybe you have a main job, and your freelance work is a side hustle. Increasing your withholding from your regular pay is often the simplest, most effective, and truly painless strategy.
Easier than making separate payments.
Way easier. Instead of tracking quarterly payments, you just adjust your W-4 once with your employer. You can achieve this by simply filing a new Form W-4, Employees Withholding Certificate. It's an almost invisible way to meet your tax obligations on that other income.
That's such a practical tip. It's often much easier to just have a bit more taken out of a regular paycheck than to remember those quarterly dates. What about other income sources where people might have withholding options, like pensions or maybe certain government payments?
Absolutely. The principle of adjusting withholding extends to other income streams, too. If you receive a pension or annuity, you can use Form W-4P, that's P for pension, withholding certificate for periodic pension or annuity payments, to easily start or change the tax taken out.
Okay, W-4P for pensions.
Right. Similarly, for certain government payments, you can use Form W-4V, V for voluntary withholding request. And for non-periodic payments, like, say, distributions from retirement plans that aren't annuities or eligible rollover distributions, Form W-4R allows you to set up withholding.
Lots of W-4 variations.
Yes, there are. And to figure out precisely if and how much your withholding needs to be adjusted across all your income sources, the IRS provides a fantastic online tool, their Tax Withholding Estimator. You can find it at irs.gov W-4 app.
W-4 app, got it.
Think of it as your personal tax optimization assistant. It helps you fine-tune your payments throughout the year, preventing both overpayment, where you give the IRS an interest-free loan, and underpayment, which leads to penalties.
That tool sounds incredibly valuable for getting it just right. So, adjusting withholding is one big strategy. Beyond that, how can anticipating tax law changes for 2025, like, say, updates to standard deductions or credits, play a role in better planning and ultimately reducing the estimated tax you need to pay?
Oh, they can play a massive role. Staying informed about what's new from the IRS is a direct pathway to optimizing your tax position, potentially lowering your estimated payments. For 2025, for example, the standard deduction amounts have increased across the board, which is fantastic news for many taxpayers.
Higher standard deduction means less taxable income, right? What are the numbers for 2025?
Exactly. For those married filing jointly or a qualifying surviving spouse, your standard deduction is now $30,000. For heads of household, it's $22,500, and for single filers or those married filing separately, it's $15,000.
So for many, that translates into a larger chunk of their income that won't be taxed at all, automatically reducing their overall tax liability right from the start. That's a significant benefit. Are there special rules for dependents or maybe additional deductions for age or blindness that folks should also factor in?
Yes, absolutely. If you can be claimed as a dependent on someone else's 2025 tax return, your standard deduction is limited. It's the greater of $13,350 or your earned income plus $450, but it can't exceed the full standard deduction amount for your filing status.
Okay, limits for dependents. What about age or blindness?
Right, there are valuable additional increases for age, 65 or older, or blindness. For instance, if you're an unmarried individual, single or head of household, and you're 55 or older or blind, you get an extra $2,000 on top of your standard deduction.
$2,000 extra. Nice.
Yeah. If you're both 65 or older and blind, that's a $4,000 increase. For married individuals, joint, separate, or qualifying surviving spouse, it's an additional $1,600 if one person meets one of those criteria, 65 plus or blind. If both conditions apply to one person, it's $3,200 extra.
And if both spouses are older?
If both spouses are 65 or older and filing jointly, that's an additional $3,200, $1,600 each, or a substantial $6,400 extra if both are 65 or older and blind. These additions can significantly reduce your taxable income and thus your estimated tax needed.
That's a lot of potential deductions stacking up. These directly influence your estimated tax liability, which is powerful. Any crucial caveats about the standard deduction we should mention?
There's one important caveat. Your standard deduction becomes zero if your spouse itemizes deductions on a separate return.
Can't double dip.
Exactly. Or if you are a dual status alien and don't elect to be taxed as a resident alien for 2025. Another key change for 2025 that impacts calculations, particularly for the self-employed, is the Social Security tax cap.
Right, the maximum income subject to Social Security tax. What is it for 2025?
For 2025, the maximum amount of earned income subject to Social Security tax is $176,100. This threshold is critical when you're calculating your self-employment tax obligations, as income above this amount isn't subject to the Social Security portion of that tax, just the Medicare part.
Okay, $176,100. Good number to know. Speaking of self-employment tax, that's a massive component for many of our listeners, those independent contractors. And it's also a source of a significant deduction, right?
Right.
How do expanded credits play a role first? And then let's dive into figuring out that SE tax deduction.
Right. Expanded credits are truly powerful because they are direct tax reductions. Unlike deductions that just reduce your taxable income, credits reduce your tax liability dollar for dollar.
More bang for your buck.
Definitely. For 2025, for instance, the maximum additional child tax credit amount has increased to $1,700 for each qualifying child. And for the adoption credit or exclusion, the maximum has increased to $17,280, though there's an income phase-out starting. Let's see, below $299,190 for 2025.
So these credits directly lower your tax bill, which in turn can significantly reduce the amount you need to pay in estimated taxes.
Exactly. Understanding and accurately projecting these credits is a vital part of proactive planning, making sure you don't overpay throughout the year. That's a key tax-saving move right there.
Okay, so projecting credits accurately saves you money up front. Now, let's delve deeper into that self-employment tax. For many independent contractors, this is a huge chunk of their tax burden, but there's also that deduction. How do you figure out the self-employment tax and that deduction for estimated tax purposes?
Okay, this is a critical calculation for anyone who's self-employed. It immediately provides a valuable deduction that reduces your overall taxable income, which is great for lowering your estimated payments. When you're working through the 2025 estimated tax worksheet, especially for projecting your AGI and total tax, you need to get this right. Here's a simplified breakdown.
Okay, walk us through it.
First, you start with your expected total income and profits that are subject to self-employment tax. This typically comes from your Schedule C for a sole proprietorship, maybe Schedule F for farm income, or even Schedule K1 for certain partnership income.
And if you have farm income, there's that small adjustment for Conservation Reserve Program payments you mentioned.
Correct. If you have farm income and also receive Social Security retirement or disability benefits, you'll make a small adjustment for any expected Conservation Reserve Program payments that might be on your Schedule F or K1. Once you have that adjusted net profit, here's the key step. You multiply it by 92.35%.
0.9235. Why that specific percentage?
It's crucial because it accounts for the fact that you effectively get to deduct half of your self-employment taxes before calculating the tax itself. It's a bit circular, but this percentage handles it. This result is your net earnings from self-employment.
So you're not paying self-employment tax on 100% of your net profit, but on 92.35% of it. That's an immediate reduction, a built-in tax saver. What's next after you have that net earnings figure?
From that net earnings figure, you calculate two parts: Medicare tax and Social Security tax. The Medicare tax is pretty simple. It's 2.9% of your entire net earnings from self-employment. No income limit on that one.
Okay, 2.9% Medicare on everything.
Right. For the Social Security tax, it's 12.4% of your net earnings, but only up to that maximum income limit for 2025, which we said was $176,100.
Right, the cap.
And it's vital to remember, if you also have wages from a W-2 job that are subject to Social Security tax, you have to factor those in. Your combined Social Security contributions from wages and self-employment can't exceed that $176,100 limit.
So you don't overpay the Social Security part.
Exactly. The total of these two, the Medicare tax plus the Social Security tax up to the limit, is your total self-employment tax for the year.
Okay, that's the tax itself. And here's where that significant deduction for your AGI comes in, the part that helps reduce your overall taxable income and lower those estimated payments.
Exactly. This is the crucial benefit, the tax-saving part for the self-employed. The deduction for self-employment tax is 50%, one-half of the total self-employment tax amount you just calculated.
So you calculate the tax, then cut that number in half for the deduction.
Correct. This 50% deduction is then subtracted when you figure your adjusted gross income, or AGI, on your main tax form and on the estimated tax worksheet. It directly reduces your taxable income and consequently your overall tax burden. It's a powerful mechanism that genuinely helps self-employed individuals manage their finances and lower their tax bill.
That makes a huge difference. Understanding that 50% deduction alone is a major tax-saving insight for self-employed folks. Okay, so now that we understand who needs to pay and some key strategies for reducing the burden, let's talk about the mechanics. How do you actually figure out your estimated tax accurately? What tools do you need to get started?
Right. Getting the calculation right is key to avoiding penalties. You'll need a few essential tools and resources. Your primary guide will be the 2025 Estimated Tax Worksheet itself, which is part of Form 1040-ES, along with its specific instructions.
The worksheet and instructions, got it.
You'll also absolutely need the 2025 tax rate schedules. These are critical for calculating your actual tax liability based on your projected income and filing status.
Where do you find those?
They're usually included in the Form 1040-ES package or available separately on irs.gov around the start of the tax year. And while you're looking forward to 2025, having your 2024 tax return and its instructions nearby can serve as a valuable reference point, though always remember to factor in the what's new changes for 2025 we discussed.
Like the new standard deduction amounts.
Exactly. And for the most detailed information, IRS Publication 505, Tax Withholding and Estimated Tax, is the big one. Also, Publication 509, Tax Calendars, is handy for keeping track of due dates.
Pub 505 and Pub 509. Okay. It sounds like a bit of a puzzle where you need all the right pieces. Let's walk through the estimated tax worksheet, maybe hitting the key lines listeners should really focus on. Starting with line 1 for adjusted gross income.
Okay, line 1, estimating your adjusted gross income for 2025. It's vital here to incorporate all the changes we just discussed. Definitely those updated standard deduction amounts will affect your thinking, even though the deduction itself comes later. And crucially, if you're self-employed, remember to factor in that 50% self-employment tax deduction we just calculated when figuring your AGI.
Because that deduction lowers your AGI.
Right. This line is the foundation of the whole calculation, so getting it as accurate as you reasonably can is paramount.
And line 2 for deductions, what goes there?
On line 2, you'll enter your projected deductions. This will either be the estimated total of your itemized deductions if you plan to itemize things like medical expenses above a certain threshold, state and local taxes up to the limit, mortgage interest, charitable contributions.
The usual Schedule A stuff.
Right. Or for most taxpayers, you'll simply enter your new higher standard deduction amount for 2025 based on your filing status. Don't forget to also include the qualified business income deduction, or QBI deduction, if you expect to be eligible for that as well. That can be a significant reduction for eligible business owners.
Okay, so line 1, AGI minus line 2, deductions, leads to line 3, your projected taxable income. Then on line 4, you actually calculate the tax. How exactly do those tax rate schedules work for this calculation, especially with the different income brackets?
Right. Line 4 is where you apply the 2025 tax rate schedules. You'll pick the schedule that matches your expected filing status: single, head of household, married filing, jointly qualifying, surviving spouse, or married filing separately.
And these show the different rates.
Yeah, these schedules lay out the graduated tax brackets, 10%, 12%, 22%, 24%, 32%, 35%, and 37%, along with those specific income ranges for each bracket within your filing status. It's a progressive system, meaning different chunks of your income get taxed at different rates. Your first dollars are taxed at the lowest rate, the next chunk at the next rate, and so on.
So not all your income is taxed at your highest bracket rate.
Correct. That's a common misconception. A crucial caution here, though. If you anticipate having qualified dividends or a net capital gain, or if you plan to exclude foreign earned income, you can't just use the standard rate schedules directly. You'll need to use specific worksheets found in IRS Publication 505 to figure your tax correctly, because those types of income often get special, sometimes lower, tax treatment.
That's a critical note. Using the wrong calculation there could throw things off significantly. What about other taxes and credits that come into play later on the worksheet, like line 7 for credits?
Good question. On line 7, you'll factor in your various non-refundable tax credits. It's important not to include any income tax withholding you expect on this line that comes later, counted as a payment already made. But you will include other credits you expect to qualify for, like maybe education credits or the foreign tax credit, things like that. You can generally refer to the prior year's Form 10400-1040 SR instructions for guidance on what credits might apply, as many rules carry over.
Okay, non-refundable credits on line 7. Then line 9 is for?
Line 9 is where your total estimated self-employment tax goes, that figure we calculated earlier based on your net earnings, using the 92.35% rule and the 2 tax components.
Got it. And line 10, other taxes. What needs to be included, or maybe more importantly, excluded there to ensure you're not paying taxes early that are actually due later with the return?
Right. Line 10 is for certain other taxes you expect to owe. For instance, you'll generally include those household employment taxes we talked about, but only if you'll have federal income tax withheld from other sources, or if you'd be required to make estimated tax payments anyway.
Okay. What should you not put on line 10?
It's equally important not to include certain taxes here because they're paid with your final return, not through estimates. Things like uncollected Social Security and Medicare tax on tips reported to your employer, any recapture taxes like for a federal mortgage subsidy or certain excise taxes, those are typically due when you file your annual income tax return.
Right.
You do need to consider adding things like the additional Medicare tax for higher earners and the net investment income tax if those apply to your situation.
NIT, that's the extra 3.8% tax on investment income for higher earners, right?
Correct. That needs to be factored into your estimated tax if you expect to owe it.
That distinction is important, paying the right things at the right time. And then there's line 12B, which uses your prior year's tax. This is absolutely critical for that safe harbor rule, the 100% or 110% rule we talked about. How exactly do you figure out that specific amount? Because it's not just the bottom line number from your last return, is it?
You're exactly right. It's not just the bottom line. Line 12B, required annual payment based on prior year's tax, is crucial for that safe harbor. To figure your 2024 tax for this line, you start with the total tax amount shown on line 24 of your 2024 Form 1040 or 1040 SR.
Okay, start with line 24 from last year.
But then you need to reduce it by certain specific items. These include things like any unreported Social Security and Medicare tax from Form 4137 or 8919, any tax on excess contributions to accounts like IRAs from Form 5329, and importantly, any refundable credit amounts from lines 27, 28, and 29 of your 2024 Form 10410-40 SR and specific lines on Schedule 3.
So you back out the refundable credits, like EITC, or the refundable part of the child tax credit.
Exactly. You're basically isolating the core income tax liability from the prior year. It's a very specific adjusted figure that the IRS uses for this safe harbor calculation.
That makes sense. And what about those special considerations, again, the higher income folks, or if your filing status changes from one year to the next, how does that affect line 12B?
Excellent questions. These nuances are vital. As we discussed, if your 2024 AGI was over $150,000 or $75,000 if you're married, filing separately for 2025, you don't use 100% of that adjusted 2024 tax. You use 110% of it on line 12B, unless, of course, you qualified under the farming or fishing rules.
Right, that 110% rule kicks in.
Yep. And if you file joint returns in 2024 but plan to file separately in 2025, or vice versa, there are specific rules in Pub 505 for how to allocate or combine the prior year's tax liability to figure your individual safe harbor amount for 2025.
Yeah.
It gets a little complicated, but the instructions cover it.
And if you didn't file a 2024 return, or maybe it covered less than 12 months?
Then you simply can't use the prior year safe harbor. You skip line 12B, and your required payment will be based solely on the 90% of your current year 2025 tax liability.
Okay. These calculations really underscore the importance of accuracy to avoid those penalties. But what if your income isn't steady throughout the year? Like you run a seasonal business, maybe landscaping like you mentioned, or you expect a big capital gain late in the year. How do you match estimated tax payments to that uneven income so you're not overpaying early on and getting penalized later?
That's precisely why the annualized income installment method exists. And it's an incredibly powerful tool, a real tax-saving strategy for managing fluctuating income.
Annualized income method, how does it work?
Okay, imagine that landscaping business booming in spring, summer, slow in fall, winter. Or maybe you sell a big stock holding in November. If you just divided your total estimated tax into 4 equal payments based on your projected annual income, you might pay too little in the later quarters when your income spiked, even if your total payment for the year was enough. That could trigger a penalty for underpaying those specific quarters.
Ah, because the penalty is assessed per quarter.
It's exactly. The annualized income method lets you calculate your income and deductions separately for each payment period, like Jan 1, March 31, then Jan 1, May 31, etc., and figure the tax on that annualized income. You then pay the required percentage for that period. Its primary purpose is to lower or even eliminate your required payments for the earlier, lower income periods, thus helping you avoid penalties that could arise from that uneven income stream.
So you pay more when you actually earn more.
Precisely. If you choose to use this method, which can be more complex, you'll need to file Form 2210, Underpayment of Estimated Tax, specifically including Schedule AI, Annualized Income, with your 2025 tax return to show the IRS how you calculated your payments. It's a smart way to align your tax payments with your actual cash flow, preventing overpayment when income is low and ensuring you're covered when it spikes.
That makes perfect sense. Prevents you from overpaying early when cash might be tight. All right, we've talked about who needs to pay, smart strategies to reduce the burden, and how to calculate it. Now for the really practical side. Making your payments. When are they actually due? And what are the best, most convenient ways to pay to avoid those late payment penalties?
Understanding the payment due dates is absolutely crucial, probably the #1 way people accidentally incur penalties. For most folks, calendar year taxpayers, the standard quarterly due dates are typically
April 15, 2025.
June 16, 2025, because June 15th is a Sunday this year.
Okay, mid-April, mid-June.
Third payment, September 15, 2025,
Yeah.
and the fourth payment, January 15, 2026.
Mid-September and then mid-January of the following year for the last one. So missing one of those dates, even by a day, could trigger a penalty. That sounds like a common pitfall.
It absolutely can be, and it's a very common reason people face penalties. The consequence of making late or insufficient payments is indeed a penalty for underpaying your tax, and it's calculated on each underpayment for the number of days it remains unpaid. Interest, basically.
Ouch.
However, there's a valuable exception for that fourth payment, the one due January 15th, 2026. You actually don't have to make that specific payment if you file your 2025 tax return by February 2, 2026. That's allowing for the usual end of January filing timeframe plus a buffer, and you pay the entire remaining balance due with your return.
Oh, okay. So if you file and pay everything really early, you can skip that last estimated payment. That's a nice bit of flexibility.
It is. And remember the postmark rule for mailed payments. The date of the U.S. postmark is generally considered the date of payment. For fiscal year taxpayers, their due dates are just adjusted based on their fiscal year, 15th day of the 4th, 6th, 9th months of the current fiscal year, and 1st month of the next.
And what if a deadline falls on a weekend or holiday?
Always remember, If a due date falls on a Saturday, Sunday, or legal holiday, you automatically get to use the next business day. IRS Pub 509, the tax calendar, lists all the federal legal holidays for your reference.
Good tip. That flexibility for the last payment is certainly a relief. How about the actual payment methods? The IRS seems to really push online payments these days, right? For convenience and security.
They absolutely do. The IRS strongly encourages online payments, and honestly, for good reason. They're typically the most convenient, fastest, and secure options available. You have several choices here.
Like what?
You can use your own IRS online account at irs.gov account. You can log in there, view your balances, see payment history, payment plan details if you have one, and make payments directly.
Okay, the online account.
Another really popular and often preferred option is IRS Direct Pay. This lets you make direct transfers right from your checking or savings account. The best part about Direct Pay, there's absolutely no cost to you, no fees.
Free is good. IRS, direct pay. What if someone prefers using a debit or credit card or maybe Apple Pay or something?
You can certainly pay using a debit card, credit card, or a digital wallet through the irs.gov payments website. But it's really important to be aware that these methods typically incur a processing fee. That fee comes from the third-party payment processor, not from the IRS itself.
Ah, so there's a convenience fee for cards and wallets.
Usually, yes. You can also pay by phone using a debit or credit card through those same service providers, again, with likely fees. Another very convenient option, electronic fund withdrawal, or EFW, is available when you e-file your federal taxes using tax prep software or through a tax professional. You basically authorize the payment when you file.
Integrated e-file and e-pay.
Exactly. And if, for some reason, you find you can't pay your full estimated tax amount by the due date, you can often apply for an online monthly installment agreement at irs.gov UOPA. Keep in mind, though, a user fee usually applies for setting up an installment plan.
So many digital options. What about the Electronic Federal Tax Payment System, EFTPS? I hear about that sometimes, especially for businesses. Is that different from these other online portals?
Yeah, EFTPS is another excellent electronic payment system. It's often favored by businesses or individuals who have pretty consistent estimated payment needs, maybe larger amounts. It's a free service from the Treasury Department that allows you to pay your taxes online or by phone directly from your bank account.
Free sounds good again.
It does require an initial enrollment process first, though. You either enroll online at eftps.gov or they can mail you an enrollment form. Once you're enrolled, it's highly secure and reliable, and you can schedule payments in advance.
Okay, so EFTPS needs enrollment, but it's free and reliable. What if someone really prefers not to pay online or by phone? Can they still pay with cash or, a good old-fashioned check?
Yes, absolutely. Cash payments are an option, but please never send cash through the mail. That's just asking for trouble.
Right, definitely don't mail cash. How do you pay with cash then?
You can find information on different cash payment methods and locations, often through retail partners like certain stores, at irs.gov PayCash. For checks or money orders, you'll use the Estimated Tax Payment Voucher, Form 1040-ES.
The voucher. Do they mail those out?
Sometimes. If you made estimated tax payments electronically or by mail for 2024, you might receive a 1040-ES package in the mail with pre-printed vouchers showing your name, address, and SSN. If not, or if you need extras, you can easily print a copy of an unused voucher from the Form 1040-ES instructions on the IRS website.
Okay. And what are the crucial details for filling out that voucher and writing the check itself? Getting that right seems key to making sure your payment gets credited correctly and on time.
Absolutely. Precision here avoids major headaches later. You'll want to clearly print or type your name, address, and your Social Security number or ITIN if you use one on the voucher in the spaces provided.
Use the main filer's info first if it's joint.
Yes, if it's a joint payment for a joint return, make sure to include your spouse's name and SSN too, and list them in the exact same order as they will appear on your actual joint tax return. Consistency is key. In the dedicated box on the voucher, you'll enter only the specific dollar amount you are sending by check or money order. Don't include any prior year overpayment you might be crediting towards 2025, just the amount of the check.
Okay, just the payment amount. What about the check itself?
Make your check or money order payable to United States Treasury, that exact wording. And importantly, on the memo line of your check, write 2025 Form 1040-ES and your Social Security number, the one listed first on the voucher of joint.
Memo line, 2025 Form 1040-ES and SSN. Got it. Any other tips for mailing?
Yes, a small but crucial detail. Enclose your check or money order with the voucher, But do not staple or attach the payment to the voucher. Just put them loose in the envelope together. And again, never send cash.
Don't staple. Okay. And where do you actually mail these check payments? I imagine it's not just one single address for everyone across the country.
You're absolutely correct. The exact mailing address depends on where you live. The IRS has different P.O. Box addresses designated for processing payments from different states and territories.
So how do you find the right address?
It's crucial to always consult the specific instructions for Form 1040-ES for the current year, 2025 in this case, or check the IRS website directly under Where to File Form 1040-ES. That will give you the precise P.O. Box address for your state of residence. Using the wrong one could delay processing.
Makes sense. Use the official instructions or website, and you mentioned P.O. boxes.
Right. Remember, when mailing to an official IRS P.O. box, you must use the U.S. Postal Service. Private delivery services like FedEx or UPS generally cannot deliver to P.O. boxes.
Good point. USPS only for P.O. boxes. That's a comprehensive guide to payments. But what if your financial situation changes significantly after you've already started making estimated payments? Say you get a new, higher-paying job mid-year, or maybe you sell some stock unexpectedly, or have a big unexpected expense. Can you adjust or amend your estimated payments partway through the year?
Yes, you absolutely can, and frankly should amend your estimated tax payments if your financial picture changes substantially during the year. It's all about paying the right amount as you go.
So how do you do that?
If your income, deductions, or credits shift significantly either up or down, the smart move is to refigure your total estimated tax for the year. You'd use the 2025 estimated tax worksheet again, but this time incorporating your new projections.
Okay, recalculate the total needed.
Right. Then, to determine the revised payment amount due for each remaining payment period, you'll need to refer to the specific instructions under Amended Estimated Tax in Chapter 2 of IRS Publication 505. It walks you through how to adjust the remaining payments.
So Pub 505 explains how to adjust the later payments.
Exactly. It's about being responsive to your financial reality. It's important to be aware, however, that even if you amend and increase your later payments, if an estimated tax payment for a previous period was less than what it should have been based on your income up to that point, using the annualized method, for example, you might still face a penalty for that earlier underpayment when you file your return. The IRS really expects you to pay accurately as you go each quarter.
So catching up later doesn't necessarily erase an earlier shortfall penalty. Good to know. Any quick admin notes, like name changes?
Yeah, a quick administrative point. If you change your name, maybe due to marriage or divorce, and you made estimated payments under your former name, it's a good idea to attach a brief statement to your 2025 tax returns explaining this. Show all the payments made, the name used, and the SSNs, and of course make sure you report the name change to the Social Security Administration too. This just helps the IRS match everything up smoothly and avoid processing delays.
Makes perfect sense. It's about being reactive to your evolving financial situation throughout the year, not just setting it and forgetting it back in April. Okay, finally, let's bring it all home. How exactly are penalties applied for underpayment? And what's the ultimate safeguard or maybe the right mindset to truly avoid them?
Okay, the penalty. It's applied if you didn't pay enough estimated tax throughout the year, or if you didn't make your payments on time, or if you didn't pay the required amount for each payment period.
So not enough, not on time, or not the right quarterly amount.
Pretty much covers it. The penalty is calculated on each underpayment for the number of days it remains unpaid. It's essentially an interest charge on the amount you should have paid earlier. This is why getting your estimates as accurate as possible and making those timely quarterly payments or using the annualized method correctly is so critically important. It's not just about the total amount you owe by April 15th, but the disciplined timing of each installment throughout the year.
So it's not just about the total, but the timing of each installment is key to avoiding the penalty. Are there any situations where these penalties can actually be waived, maybe if something unexpected happens?
Yes, they can be waived, but only under certain specific conditions. The IRS isn't completely inflexible. For example, a waiver might be granted if you failed to make a required payment because of a casualty, disaster, or other unusual circumstance, and it would be inequitable to impose the penalty.
Like a natural disaster hitting your area.
Exactly.
Or
Another common reason is if you retired after reaching age 62 or became disabled during the tax year 2025 or the preceding tax year 2024, and your underpayment was due to reasonable cause and not willful neglect.
okay, retirement or disability could be grounds. Where do you find the details on waivers?
For all the precise details on these waiver conditions and how to request one, you'll need to refer to the instructions for Form 2210, Underpayment of Estimated Tax by Individuals, Estates, and Trusts. You usually request the waiver when you file this form with your return. While waivers aren't granted automatically, it's a small but important detail to be aware of if unforeseen circumstances beyond your control genuinely prevent you from paying on time.
Good to know there's a potential safety valve, even if it's specific. So the goal here is truly to avoid that penalty in the first place by meeting one of those tests, the 90% or the 100%, 110% rule. But even if you meet those requirements perfectly to avoid the penalty, that doesn't necessarily mean you won't owe any tax at filing time, does it?
Precisely. That's a crucial final safeguard to understand, and it's a very common misconception. Hitting those safe harbor minimums protects you from the penalty, but it doesn't guarantee you've paid your full tax liability.
So you could still owe money in April, even without a penalty.
Absolutely. Remember, the 90% rule leaves 10% potentially unpaid, and the 100% or 110% of prior year tax rule only works well if your income stays the same or goes down. If your income went up significantly, paying 100% of last year's lower tax might avoid the penalty, but you'll still owe the difference when you file. The estimated tax system's primary goal is to ensure enough tax is paid throughout the year to prevent that underpayment penalty.
So what's the approach if you want true peace of mind, owing nothing come April 15th?
If you want to ensure you owe absolutely nothing more at filing and really have that peace of mind, you always have the option to aim higher than the minimum required payment. Ideally, you'd pay the full amount shown on line 11C of your estimated tax worksheet. That line represents your total estimated tax calculated for the year. Paying that amount, divided into 4 installments, is the most proactive strategy to ensure you won't have any surprise tax bills or penalties come April 15th. Gives you ultimate control over your financial situation.
Today, we've really taken what might seem like the complex world of estimated taxes and hopefully transformed it into a clearer, more actionable strategy for genuine financial preparedness. From truly understanding who needs to pay, to leveraging those increased standard deductions and the specialized rules for different incomes, to mastering the convenient payment methods, you now have the tools and the insights to not just comply, but to actively avoid penalties and manage your money smarter. This deep dive isn't just about ticking a box on a form, it's about empowered financial decision-making, giving you more control over your hard-earned dollars.
And if we connect this to the bigger picture, it's really clear that proactively engaging with your tax obligations is, well, it's a fundamental cornerstone of sound financial health. Knowing these rules, from the powerful safe harbors that protect you to the strategic value of that self-employment tax deduction and the flexibility offered by the annualized income method, it truly empowers you. It allows you to optimize your cash flow, making sure more of your money stays in your pocket throughout the year, rather than being lost to unnecessary penalties levied by the IRS or even just overpaid as an interest-free loan. It's really about being informed so you can be financially resilient.
So, as you look ahead to your financial year, maybe ask yourself, are you simply paying your taxes as they come up, or are you strategically managing them to ensure every dollar truly works for you? What hidden tax surprises those potential penalties might you uncover and proactively prevent now that you're equipped with this knowledge? And maybe, how will this understanding empower you to forecast your financial future with a bit more confidence this year?